Hi there, my name is Jonathan Dio. I'm the president of Dio Wealth Management and the founder of the Happiness Dividend blog and the Mindful Money Toolbox. Today I want to talk about volatility, that sometimes vicious zig and zag that the market throws our way. But just before I start, I want to say thank you to our clients. When I'm out in the world talking to my friends, taking kids to school, socializing with neighbors, coaching soccer, I'm routinely cornered with questions about the market, especially during times of market turmoil. Now, I do my absolute best to kind of get out of these kinds of conversations when people aren't clients because I don't know their plan. I don't know how they're invested, so I can't possibly know how whatever's going on in the world might affect them specifically. But they must know this. So what they're really asking for is, hey, Jonathan, what's going to happen next? Which is something that nobody knows because it's impossible to know. It's crystal ball stuff. And that's the very reason for the possibility of future returns. It's the anxiety around not knowing that allows for a return in excess of the risk-free rate to begin with. If everything was knowable, if everything was known, there would be no opportunity. You see, no one knows, but everyone feels. And this is precisely why I want to thank our clients. Not a single one of them called with a concern the days the market was going sideways, ups and downs. Maybe they knew that we were busy. Maybe they knew that we were trying to do something and take advantage of the opportunity. Or maybe they were blissfully going about their lives, which is kind of what I hope. The only calls and emails we received were to ask how we're weathering the storm. But no one panicked. That's a sign of success in my book. Now, I want to talk about volatility itself, mention very briefly what actions our process had us implement, but I'm not going to spend much time talking about current market conditions or an economic review. We just did our halftime report. If you want a broader market economic discussion, you can look at the links below, and we're going to make sure we include those there. Since we gave that presentation, not much has changed, except that the volatility we've been talking about as mysteriously and inexplicably absent has finally returned. Volatility is reality. It's always been reality, but we forgot for a while. But volatility is not, in and of itself, risk. Volatility is only risk when we mix it with panic. We all must admit, as I do here and now, that we have no idea where the market's going to go in 3 days, 3 weeks, or 3 months. I don't know, I don't care, it doesn't matter. I'm not investing in a way that relies upon my successfully predicting the immediate future. What I'm looking at is what's going to happen over the long period of time. If it goes down more from here, I know what to do. If it goes up from here, I have a plan. I have a plan and a process that I believe in, and I'm going to follow it, regardless of what the pundits say on CNBC or regardless of what I feel in this moment. Now, regarding volatility, the first question we should ask before we freak out is what's normal? Now, looking at the S&P 500 with FactSet and JP Morgan's Guide to the Market, from the Great Depression, 1928 till today, average volatility is the following. A 3% decline happens every week. It happens and takes 2-3 weeks to recover. A 5% decline can take 2-3 months to recover. A 10% decline happens every year, can take 8 months to recover. 20% plus declines, averaging 33%, occur every 5 to 7 years and can take 1 or 2 years to recover. These are just average numbers that I'm showing you. There's absolutely no sense of predictability in them such that after 6 years of a market recovery you would expect a 20% decline. It just doesn't work that way. One will eventually, certainly come, but we can't know when it'll get here. There is no bell at the top and there's no bell at the bottom. I state again the same phrase we started with, volatility is reality. It's only risk when we mix in panic. And volatility, the uncertainty it creates, is the real source of the investment returns we all want. If you take away volatility, you take away return. Volatility is a given. It's unpredictable, but this does not make it unmanageable. For me, I like to think about the basics. When I'm investing, I'm buying something. The something I'm buying is earnings. The price I pay for a dollar earnings matters to me. The price per dollar of earnings is often referred to as the PE ratio, and it can be applied to companies, countries, industries, or even entire markets. I invest, putting it simply, in 3 very different diversified portfolios of equities: developed world, US, and emerging markets. I can compare the price of $1 earnings between these 3 categories over time. I can compare the price of $1 earnings between them and the global market, and I can compare each one to itself over time and throughout history. Before the correction we experienced on the 21st and 24th of August, which was our first correction in 1,400 trading days, global equities have gotten a little bit overvalued. So we had been rebalancing out of them leading up into that correction in August. And when the correction hit, we had some liquidity available and began moving some of that money back into equity at those lower prices. We bought low. Now, more conservative portfolios had less movement, and more aggressive portfolios had more. We left a little liquidity there on the sides just in case that buying opportunity got even better. In the process, we moved our portfolios from a middle weighting to risk to a slight overweighting to risk. If our portfolios bounce back, if they return to the position of light overvaluation, we will take that risk back off the table. We'll sell high. If, however, market turmoil picks up and the correction turns into a bear market, and maybe we see a 20% decline, we'll move some of that safety money that we have on the sides over into the equities. This is why we keep that liquidity there, to take advantage of the opportunity when it presents itself. And you can be assured that you will likely have that opportunity to buy lower. It just requires patience. Then the market will do what the market will do. I'm not trying to predict because no one can predict. In the meantime, I'm going to continue to dollar cost average into the great companies in the US and the world. I suggest you do the same. Have a plan, stick with that plan, watch patiently as the refrain, "This time is different," slowly but surely becomes "This too shall pass." I want to thank you very much for listening, and good luck.